In this week's video, we'll review what may turn out to be the most important charts on Wall Street. As we covered in last week's video, since Q1, maybe February, March of this year, it's been very hard to understand what the real theme is behind trading in the market because there's been a ton of rotation between growth and value going on. Before we dig into the latest charts that can help us with this topic, let's quickly review a couple of data sets that we covered in the July 9th video. You may remember this was from LPL Research, that it was rare for the S&P 500 to make 7 consecutive new all-time highs. Typically when that happened, good things happened in the stock market looking out 12 months. And you may remember we wanted to know if we took these dates that LPL Research identified on the left side of the screen and calculated the max 6-month historical drawdown, which will give us some idea at that point what the historical drawdown might look like between mid-year 2021 and year-end 2021. You may remember the drawdowns were somewhat muted. And this chart that we covered on July 9th helped us understand what that type of drawdown might look like in the present day, and we presented a chart that was dated July 8th. After the sell-off, the sharp sell-off that took place between, let's say, the latter stages of last week and Monday of this week, where did price go relative to these historical and hypothetical targets? Here's the same S&P 500 chart dated July 22nd. And you can see during Monday's session, we came right down to these hypothetical targets here and then bounced. So thus far, we really haven't seen anything in the present day that says we're off of this historical script here. And if that's the case, and since we know the 7th consecutive all-time high close came on July 2nd of this year, and we know where the S&P 500 closed on July 2nd of this year, hypothetically, if we experienced a similar 12-month gain relative to the historical cases, the S&P 500 conceivably on 7/2/2022 could be hovering somewhere around 4,800, simply helping us keep an open mind about better than expected outcomes looking out approximately 1 year. And before we jump into the important charts that can help us with this topic, let's try to gain a little bit better understanding relative to the amount of damage or lack thereof that was done during the past 5 trading sessions. We know from past videos we would prefer not to see a trend break like this or this. Chart on the right screen, as of the close on Thursday, July 22nd, we do have some weakness here, but this looks a lot better here where my cursor's moving around relative to this look here and this look in here where eventually bad things happened in the stock market. If you look at these breadth charts a little bit more closely, you'll see a common theme is the more narrow the index or the more it relates to large cap or mega cap, the better shape that it tends to be in. That's the case with the NASDAQ 100. This is what we don't want to see. Instead of a possible trend break like this or like this, we're knocking on the door of a new all-time high as of Thursday, July 22nd. This is a volume-based indicator. If we look at the indicator based solely on advancing and declining issues, it's a little bit more concerning, but we're still holding this trend line here where my cursor's moving around that was established at the March lows of 2020. We already looked at the indicator for the more narrow NASDAQ 100. How does it look for the broader NASDAQ composite? Considering the indicator printed a new high for the rally here as of the close of Wednesday, July 21st, it's hard to make the argument that this looks like this concerning look here or this concerning look here. Similar concepts relative to the look we would like to avoid. This was the look of the chart that we covered in a previous video. This chart was dated July 15th, and we were still holding this trend line. As of July 22nd, this too has a pay attention with an open mind type look here. We have seen deterioration, And this is really the weakest look that we've seen here in recent weeks and months, really relative to any time looking in the rearview mirror since March of 2020. NYSE daily, if you're a stock market bull, you really would prefer to avoid coming down into this area here and making a lower low. Obviously, if you're a bull, you would prefer to exceed this high and this high here. Keep in mind, this is the broader NYSE Composite Index, and it looks weaker than some of the mega cap or more narrow indices such as the NASDAQ 100. If we shift gears to the weekly version of the same chart, it looks a little bit better as of Thursday's close on July 22nd, up 0.56% for the week thus far. If we can hold above this low and this low, that would be a good sign. On a relative basis, GBTC, and in isolation, has been weak since the spring. Here where my cursor is, this is the Bitcoin Trust GBTC relative to TLT, or long-term treasury bonds. This is where the S&P 500 bottomed in March of 2020, came back and tagged this area September, October. We're back in the same general area now. The only difference is thus far we've seen two closes below this upward sloping trend line. This point here coincides with some of the stalls that we've seen in some of the underperforming sectors or asset classes since, let's say, March or April of this year, including what's shown here, which is IWM, or small caps consolidating in isolation. All things being equal for risk appetite, if you're a stock market bull, it's not a showstopper, but you'd really prefer to see GBTC make a stand in this area and morph back into a look more like this or this. We'll talk more about the changes that have taken place since March of this year. Small caps relative to TLT last made a new high here, recently made a new low here in the month of July. It's a busy chart. We'll walk through it. It's easy to understand. This is the small cap index, the S&P 600, relative to the broad NASDAQ Composite Index. You can see around the U.S. election in November of last year, this is where a lot of the trends or leadership groups started to change and shift in a different direction, including small caps starting to significantly outperform the NASDAQ during this period here where my cursor's moving. After this steep advance, when we start to fall here, it looks like a counter trend move within the context of this uptrend. But the longer this goes on, the less it looks like a counter trend move. The ratio has taken out the 32.8% retracement where my cursor is of this A to B move. It's also taken out the 50% retracement where my cursor is. And maybe more importantly and concerning, it took out this high here, what once acted as resistance may now act as support. It did that here for the most part, but we broke it here. And this is the June high here in orange that held earlier this year. Here's the June high for the ratio. This is a big point of economic confidence right here in 2020. And it is concerning that this ratio is below where it was in June of 2020. Not June of 2021, June of 2020. Is there any hope for a bounce here? Yes, there is. The 61.8% retracement is down here, and that tends to coincide with this upward sloping trend line here. However, where we are now is small caps are the ones that have to prove it relative to the NASDAQ and not the other way around. So the chart in front of us right now needs to improve. That may happen, but it hasn't happened yet as of July 22nd. And maybe the more important concern or pressing concern with the small cap NASDAQ ratio is not the look of this chart in isolation, but if we look at the same ratio, S&P 600 small cap relative to the NASDAQ, on a monthly chart going back to 2006 on the left side of your screen. The concern is, until proven otherwise, it's starting to look like this move here from A to B, where my cursor's moving around now, is this move here. And it's starting to look like a 100% normal and to be expected counter trend move within the context of an existing downtrend going against small caps and favoring the NASDAQ. In fact, if we look at the plunge here from 2016, point A, to the low in 2020, point B, we didn't even retrace 38.2% of that move, and thus far we haven't even made it back to this downward sloping trend line. The other thing that's a little bit concerning, we came back, this is a monthly chart. We dropped here, rose, dropped again, and made a lower low below this monthly close right here where my cursor is. We're not using any of this to predict anything, but we know with certainty at this point, this is a long-term downtrend going against small caps. And really, to disprove that, from an evidence perspective, we have to clear the 38.2, the 50%, the 61.8. We have to clear this downward sloping orange trend line. We really need to clear this downward sloping blue 50-month moving average. We really even need more than that. We need price to be above an upward sloping 50-month moving average to really say it's a long-term established bullish trend. All of that may happen, but that's a lot of to-dos, and we trade the chart in front of us. As long as this chart is improving, the chart in front of us, and adding value where small caps are outperforming, that's fine. But as soon as we start to lose that outperformance, and we really don't have anything that resembles a long-term uptrend, that becomes concerning from an asset allocation perspective. Just like small caps needed to prove it down here at point B, they need to prove it again here. And as noted on this shorter term chart, that may happen soon because here's the 61.8% retracement. Here's the August high here from last year, and here's an area here where you can tell the ratio cared about this area, and we have this upward sloping trend line. So it is possible that we're going to get a bounce and a resumption of this uptrend. But even if that happens, we still have a lot of hurdles to cross from a prove-it-to-me perspective. This is a common theme across multiple ETFs, sectors, and asset classes at this point. It's a little bit easier to see. We've covered this chart in the past. This is RSP, equal weight S&P 500 relative to the standard weight S&P 500. Remember before we talked about the rally off the 2009 low when we had this little hiccup here, and then we resumed. So when this starts over here, you can make an argument that this looks like this hiccup here. It's a hiccup taking place below the 50-month moving average, a hiccup taking place below the 50-month. The difference, though, is this 50-month is flat and indecisive. This one is clearly down, and price was clearly rejected. Another big difference. Went up here, came down, and then printed a higher high. Here, came up, went down, went up, and now we've taken out this low here where my cursor is. Another concerning thing, we came up, closed above the orange trend line. Now it's starting to look somewhat like a failed breakout. Also, we went back to the 50% retracement and failed there. This 50% retracement is based on this high here and this low here, retracing 50% of this down move. That's not unusual within the context of an existing downtrend, meaning the downtrend could resume. Another thing that's a little bit concerning, we go from the high to the low, we failed at the 50% retracement, and the hiccup happens near the 50%. We never make it to the 61.8 here, at least yet. And now at this point, as of July 22nd, we're below the 38.2 here. Compare and contrast this with where this hiccup takes place. This hiccup takes place above the 61.8% retracement of the A to B move. This is where the bear market starts here in 2007 relative to this ratio. This is the financial crisis between point A and point B. When we get above the 38.2, the 50, and the 61.8, the odds are telling us that this is looking like a trend reversal that could stick. came back, tagged the 61.8, and then resumed. It looks a lot different than this over here at this point. We could go through very, very similar charts and concepts using small caps, mid caps, financials, energy, SP high beta, industrials, value stocks, etc. This is a very, very common theme. And it's very, very possible that this theme ties into a theme that's been in place during the entire secular bull. In our mind, the secular bull market that we're in now began on June 25th of 2013. That's the day where the S&P 500 had cleared the high from the dot-com peak, March of 2000. It cleared the high from October of 2007 before the bear market and the financial crisis. And it also went above those levels, came back, retested those levels, and started to move in the other direction on June 25th. That's a massive breakout into a secular bull, potentially. What does the secular bull look like if we compare mega caps, OEF, the S&P 100 index, relative to the S&P 1000? Those two indices are described here and here. Now what this looks like is, it's a mega cap bull market. This is a counter trend move within the context of an existing uptrend. Here's our A here, here's our B. We went back to the 50% retracement between the 50 and the 38.2 to an upward sloping 50-month moving average, and now it looks like we're resuming this uptrend. As always, the statements that we're making are based on the charts that we have in front of us. We wouldn't have been making the same statement down here. But now this ratio is starting to prove something. What could that potentially mean? It basically tells us that whatever leadership groups we had from here to here, and really from here to here, could be getting back on track. So this ratio here could look a lot more like leadership in this area here before this counter trend move. Therefore, it might be helpful to know what ETFs have performed the best since June 25th of 2013, the unofficial date of the current secular bull market. Here's the answer in the upper left-hand corner of your screen. So this is ETF performance for a handful of ETFs from 6/25/2013, down here where my cursor is, to really the present day, right here, because all of this occurs within the context of this established uptrend. From a lead lag perspective, this is basically SPY or SCHX. They're basically the same thing where my cursor is. All of these ETFs above it, leaders. Everything below it starts to put a drag on your portfolio looking in the rearview mirror relative to SPY. But if we're resuming this type of look here, it's telling us that this type of leadership may be taking over from this type of leadership here. During this period here, from about mid-year 2020, election of 2020 in here, this looks a lot different. Your leadership groups are all over here for the most part. Now it looks like we're reverting to this area here. Moral of the story for us, if that's the case, then we would want to be more tech heavy, more growth heavy, and more mega cap S&P 500 heavy. That may be OEF, the S&P 100, or the S&P 500. And this represents a significant potential shift relative to what's been happening since mid-year 2020, or let's say the election November of 2020. And if you look at this stack rank here and you look at the charts that we present in the rest of the video, and you do what we do every day, you'll see that it does look like we're reverting back to this type of leadership. This stuff is getting weaker on a relative basis. This stuff has been getting stronger on a relative basis. Right here, this stuff is leading. Here, this stuff is starting to resume leadership, long-term leadership. The long-term trend favors all of this over here until proven otherwise. What would be proven otherwise? Well, we would need to get below the 38.2, the 50, the 61.8. The ratio would need to get on the other side of an upward sloping 50-month moving average, and eventually that 50-month moving average would need to roll over. That's what a downtrend looks like. Price below a downward sloping moving average. All of that may happen, but right now this looks a lot more like this period here and maybe this period here where the uptrend resumed. Once again, trade the chart in front of us. This is the chart in front of us. That doesn't mean this is what's going to happen. This is what is happening, and our allocations currently reflect all of this. If this trend is resuming, we would expect small caps right here to underperform. Well, tech has been getting stronger, and since about March of this year, small caps on a relative basis have been getting weaker. In isolation, they've just been consolidating or moving sideways. But this is a little bit more than consolidation now, with some breaks of these trend lines. Still moving sideways as of July 22nd, though. Small caps relative to bonds, the last high made by the ratio, March of this year. Similar situation with mid caps. They look a little bit better. Made a high here in April, but still, that's a long time ago, and the ratio is starting to lose momentum. So small caps versus TLT last made a new high in March of this year. Tech stocks, IYW, and this theme is basically true for almost all the tech ETFs. They last made their highest high earlier this month in July, right here. Looking at these ETFs relative to TLT gives us a standard benchmark to compare them against. If you don't like the ratios, we can discern something very, very similar looking at the charts in isolation. IYW, technology ETF in isolation, just made a new all-time high on Thursday, July 22nd. IWM in isolation hasn't made a new high since March of this year. And TLT, IYW made a new high on Thursday. TLT is in an intermediate term uptrend here where my cursor is, but it did not make a new high on July 22nd. That may help us foreshadow the battle between these assets. But if you're a stock market bull and tech's going to lead, this ratio really needs to break out. And if it doesn't break out in the short run, it's telling us that correction or pullback odds are starting to increase. So this chart here and all these charts, they help us with asset allocation decisions. They also can help us with asset allocation decisions in terms of should we be getting defensive because it's looking like the odds are increasing relative to a correction. This ratio, even the leader, tech, this still has work to do as of July 22nd, although the last thing it did was print a new all-time high. The last low that it made that was relatively significant was back in May. So let's take these charts and see how they align with this thesis here. This ratio looks like it's trying to reestablish its uptrend. That's mega cap versus small and mid caps. Mega caps winning. If this is going to happen and this is going to happen, this aligns with it. Tech, new high. Small caps, getting weak, underperforming. This, a mixed bag. It's not making a new all-time high here. This is an intermediate term uptrend here. Still has work to do from a longer-term perspective, but this is also telling us that it's prudent to respect that this ratio hasn't broken out yet. That may happen very, very soon, but this still keeps the pullback or correction door open. And there's nothing wrong with that. It just helps us keep an open mind. So if you're a stock market bull, you basically want tech to win the battle versus bonds, and that's intuitively obvious. And while we keep focusing on this period of indecisiveness, it's extremely important to remember in terms of this battle here and what's taking place here. Tech versus bonds as of July 22nd, looking back to October of 2020. This is an established uptrend. Tech is winning that battle longer term. Conversely, bonds relative to tech, the chart in front of us is an established downtrend. So when we're consolidating sideways here, you give the benefit of the doubt to the facts. The facts are, until proven otherwise, tech is beating bonds. This is just telling us that it's subject to change, and we should pay closer attention. But ultimately, these are the type of trends we want to embrace. These are the charts we want to embrace. This is what we want to own, something that goes from the lower left to the upper right. And we want to underweight or avoid things that go from the upper left to the lower right. And right now, that's what these charts look like. This tells us it may change. This tells us it may change. But it hasn't changed yet. If this continues, and this is a reestablishment of an existing uptrend favoring mega caps over small and mid caps, under that scenario, tech should return to be the unequivocal leader of this bull market. Tech ETFs should unequivocally be beating S&P 500 ETFs. And we know tech still has some work to do versus bonds. It still has work to do versus the S&P 500, but it's making some good progress. This looks like a false bearish breakdown here, a quick reversal. Here's the counter trend move, possibly, within the context of an uptrend. If this was a new downtrend, we would expect to go back to the 38.2, the 50, or the 61.8, and then resume the existing downtrend. When you get into this area here and stay there, it's a higher probability that this is a trend reversal and this intermediate term downtrend is over. Look how long we've been above the 61.8, telling us the odds are increasing that tech is going to try to resume leadership over the S&P 500. Still has to clear this level here. Another thing to keep in mind, this ratio can be moving in this direction when really bad things happen in the stock market. So this in isolation doesn't tell us we're out of the correction woods at this point. However, unequivocally, this is a positive development for the bull market. Very similar situation here. SCHG growth versus bonds made a new high earlier this month in July. Also made a new closing high, new all-time high earlier this month. That's potentially a resumption of leadership for growth, and tech also trying to resume a leadership position, which aligns with all of this here and aligns with this here. Still has work to do, still has work to do. But it's all trending in the right direction. Growth versus stocks above the downward sloping trend line, above the 61.8% of this A to B move. Doesn't predict anything, speaks to probabilities. Energy is one of the worst performers since the secular bull began in 2013. Thus, if we're moving back to a template like this, hypothetically, we would expect energy to be getting weaker on a relative basis. Here's a look of OIH, energy, oil services relative to bonds. In recent months, it has been getting weaker and it broke below this upward sloping trend channel. The good news here is still above that June high from 2020. Like small caps, RSP relative to TLT, on a relative basis, been getting weaker. Keep in mind, this is primarily an asset allocation tool. It can help us with correction odds, but we have to keep in mind it is possible for TLT to outperform both SPY and RSP for long periods of time in a period where SPY and RSP do very, very well. That's the case here from February of 2014. The leader is TLT in green. Laggards are SPY and RSP, but they do quite well. 18% return is nothing to sneeze at. So this is not a showstopper in isolation. It helps us manage allocations and helps us manage risk. It does speak to correction odds. but it's just part of the weight of the evidence. Also noteworthy, during this period where TLT outperforms stocks, we do have some pretty significant drawdowns and periods of volatility between point A and point B. Once again, RSP underperforming TLT doesn't necessarily mean the stock market or S&P 500 is dead in the water. July 22nd, this is still concerning. The last time SCHX or SPY relative to TLT, they're basically interchangeable, made a new closing high was back in April. Again, not a showstopper, but just something to be aware of relative to risk appetite. How do we manage SPY or SCHX? We look at their charts in isolation. This helps us look at it a little bit more closely and with a little bit more skeptical eye at this point. You can see this theme in other charts. So the theme is mega caps beating small and mid caps. Is this type of look resuming? Here's another way to look at it from a very long-term perspective. This is mega caps, the biggest of the big in the S&P 500, the S&P 100, relative to small caps or IWM, OEF, relative to IWM. The longer a market goes sideways, we've been going sideways for the most part since 2003. Resistance in 05, resistance here in 08, resistance in 09, resistance in 2016, resistance late in 2018, a bullish breakout. Now what looks like a retest, we came back and tagged an upward sloping 50-month moving average favoring mega caps over small caps, and now we're back above all of these levels of past resistance. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. This chart is dated July 20th of this year. The longer we stay above all of these levels, the more relevant it becomes. Right now, mega caps versus small caps is above an upward sloping 50-month moving average and is holding a very, very long-term breakout. That's the chart in front of us. It doesn't tell us what's going to happen next. I think you can make an argument at this point that the look of this chart in the present day relative to the look over here, unless this can right itself, they're almost polar opposites, which would tell us from an asset allocation perspective, we would be off the 2009 script. And in some respects, that would make sense. Why is that? We're not in a secular bull here. Secular bull doesn't start until out here. And notice, when the secular bull starts, RSP relative to SPY begins a long-term downtrend. We're still in this secular bull, and right now we're still in a long-term downtrend here until proven otherwise. So relative to the move in 2009, this look here, this is really not what we would expect. And you may remember a few weeks ago we showed this chart and this breakdown here of the Dow relative to SPY and said really everything that we know going back to roughly the year 2000 may be wrong relative to what we see going forward. This has been a nice, neat box in here. It's not nice and neat at this point. We're into an area here that we haven't been into since this area back here at the end of the secular bull that lasted 18 years. You can make this point about every chart we're looking at. This here, human nature says we know what's going to happen. This is going to continue to move in this direction. And human nature tells us that we know what's going to happen here. We're going to move in this direction. Or, if you're biased, you may know what's going to happen. You may know this is going to right itself and move in this direction. But the base case for human beings is to extrapolate. That is very, very dangerous. If you would have extrapolated right here when things were going well, that hasn't worked out very well in recent weeks. So when we have a look like this, relative to a look like this, like many of the other topics that we talk about week in and week out, extrapolation is something that always applies. Extrapolating is predicting. Predicting brings your ego into play. It's very, very difficult to be flexible when your ego is involved. The look of this chart here hasn't made a new high in weeks. And the look of this chart here, sitting above the 61.8% retracement and sitting above this upward sloping trend line, tell us we should remain open to a wide range of outcomes, from wildly bullish to wildly bearish. And we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.